Most people look at the price. They see Bitcoin up 3%, and they think, opportunity. They see it down 5%, and they think, disaster. And then they act on that feeling. They buy because it's going up. They sell because it's going down. And they wonder, every single time, why it doesn't work. Here's the problem. Price is the result. Structure is the cause. And if you're only watching the result, you're always going to be one step behind. Professionals don't look at the price first. They look at the structure behind the price. And that difference between reacting to price and reading structure is the difference between the 5% who are consistently profitable and everyone else. In this video, I'm going to show you exactly how I read a Bitcoin chart. The same process, every single day. No special indicators, no expensive data, just a framework.
Let me show you something. Look at this level right here, same price. Two completely different situations. In the first case, price came from below, hit this level, and reversed. It was resistance. Sellers were in control. In the second case, price broke through this level, pulled back to it, and bounced. It became support. Buyers defended it. Same number, two opposite outcomes. This is why price alone tells you nothing. The number doesn't matter. The context around that number, that's what matters. Here's another way to think about it. Imagine you're driving and you see a speed limit sign, 60 miles per hour. That number means something different depending on whether you're on a highway or in a school zone. Same number, completely different meaning. Bitcoin is the same. A price level doesn't mean anything in isolation. It only means something in the context of the structure around it. So what is structure? That's what part 2 is about. When I talk about market structure, I mean 3 things: trend, levels, and liquidity. That's it. 3 things. Most traders overcomplicate this. They add indicator after indicator trying to find the answer. The answer is already there, in the structure itself. The trend is the most important thing on any chart. Not because it tells you where price is going. No one knows that. But because it tells you where the probability is. If the weekly chart is in a downtrend, the probability is that price continues lower over time. That doesn't mean it can't bounce. It means that the momentum, the dominant force in the market, is pointing down. And I never fight the dominant force. I work with it. If the weekly is down, I'm not looking for aggressive longs. I might look for a short-term bounce trade with confirmation. But I'm not positioning for a major move up against the weekly trend. That's 60 to 70% of any good trade right there. Levels are the specific price areas where the market has made decisions before. Not arbitrary lines, not Fibonacci alone. Actual points where buyers or sellers showed up in force. And price either reversed or consolidated. These levels matter because the market has memory. Participants who bought or sold at those levels remember them. And when price returns to those areas, those participants act again. That's why levels work, not magic, market memory. This is the one most retail traders never think about. And it's arguably the most important of the 3. Liquidity is where the stop losses are sitting. Every trader who is long has a stop loss somewhere below their entry. Every trader who is short has a stop loss somewhere above their entry. Those stop losses cluster at obvious levels. And the market, the institutions, the large players, they know where those clusters are. Price moves toward liquidity, not always, not perfectly, but consistently enough to build a framework around. When I look at a chart, one of the first things I ask is, where are the stop losses sitting? Above price. That's where short sellers have their stops. Below price? That's where long traders have their stops. Those clusters are targets. That's where price wants to go. So, trend, levels, liquidity. 3 things. That's the structure. Now, let me show you how I use them to make actual decisions. Before I touch a trade, before I even think about an entry, I go through 3 checks every time, no exceptions. Check number 1, context. I open the weekly chart first, always the weekly first. And I ask one question. What is the dominant structure? Uptrend, downtrend, or range? One word. That's the answer I need. If the weekly is in a downtrend, my default position is defensive. I'm not looking for reasons to buy. I'm looking for confirmation before any long. If the weekly is in an uptrend, I'm looking for pullbacks to key levels as opportunities. I'm not selling into strength. Context is the first filter. Everything else I do is filtered through this answer. Most traders skip this step. They open the daily chart or the 4-hour, and they trade what they see there, completely ignoring what the weekly is telling them. That's like navigating a ship by only looking at what's directly in front of the bow. You need to know the direction of the ocean. Check number 2, liquidity. Once I have the context, I look at where the liquidity is sitting. I use a liquidity heat map for this. It shows me where the stop-loss clusters are concentrated. I'm looking for 2 things. The nearest cluster above current price, short stop zone. The nearest cluster below current price, long stop zone. These become my reference points. If the trend is up and price pulls back, I'm watching the long stop cluster below as potential support. If the trend is down and price bounces, I'm watching the short stop cluster above as the target. The liquidity map tells me where the market wants to go. The trend tells me which direction has the higher probability. Together, they give me the zone of interest, the area where a trade might actually make sense. Check number 3, confirmation. This is where most traders get stopped out. They see the trend, they find a level, and they enter before the confirmation arrives. They buy the bounce, they get stopped out on the retest, and they say the level didn't work. The level worked fine. The entry timing didn't. I wait for a confirmed 4-hour candle close. Not a wick, not a move, a closed candle. A 4-hour candle that closes above a key level and then holds above it on the next candle. That's confirmation. Only then do I consider a position. This one rule, waiting for the 4-hour close instead of anticipating it, has probably saved me from more bad trades than any other part of my framework. Patience is not a weakness in trading. Patience is a strategy. So context, liquidity, confirmation, 3 checks every time. Now, let me show you all 3 working together on a live Bitcoin chart, okay? Live chart, let's do this. Step 1, context. I open the weekly. What do I see? Downtrend from the high. Price made a major top, and since then, lower highs, lower lows on the weekly time frame. That's the dominant structure. Downtrend, one word. That's my context. What does that mean for my decisions? It means I'm not looking for a major long position. It means I'm defensive by default. It means any bounce I see on the daily or 4 hours is a bounce within a downtrend, not a reversal of the downtrend. That distinction matters enormously. A bounce trade and a reversal trade are completely different positions with completely different risk. Step 2, liquidity. Now I look at where the stop losses are clustering. Below current price, there's a significant long stop cluster. This is where traders who bought the recent low have their stops sitting. If price drops there, those stops get hit, price accelerates down. That's the risk zone below. Above current price, there's a short stop cluster. Traders who shorted the recent bounce have their stops sitting there. If price pushes up into that zone, those stops get triggered, price accelerates up temporarily. That's the target zone above, if a bounce confirms. Now I have 2 reference points. Risk below, target above. Everything in between, I'm watching, not trading. Step 3, confirmation. Now, The 4-hour. Price bounced from a key structural level recently. That bounce is noted, but has it confirmed? I'm looking for a 4-hour candle close above the trigger level. The level that separates bounce is real from bounce is a trap. If that close happens and holds, scenario A activates. I consider a small position toward the short stop cluster above. This is a local bounce trade, not a reversal call. Risk state stays defensive. Position size reflects that. If price fails to close above the trigger level, scenario B, we go back to the structural floor. And if that breaks, next stop is the major liquidity cluster below. No prediction, 2 prepared outcomes. When the condition is met, I act. When it isn't, I wait. That's the whole process. Context, liquidity, confirmation, 3 steps, every single time. So here's what I want you to do this week. Not next month, not when you feel ready. This week. Open your chart. Go to the weekly time frame, just the weekly. Ask yourself, what is the dominant structure? Uptrend, downtrend, or range? Write it down. 1 word, then go to the daily. Find the 2 nearest key levels, 1 above current price, 1 below. These are where the market has made decisions before. Write them down. Now you have a context. Now you have a map. You don't need 15 indicators to trade Bitcoin. You need to know the direction of the ocean. And you need to know where the nearest rocks are. Weekly trend, key levels. That's the foundation. Everything that comes after, the 4-hour confirmation, the liquidity analysis, the exact entry logic, the stop placement, that's what I break down every single week in the Telegram channel. It's free. Link is in the description. Every Monday, weekly BTC structure. Every Thursday, execution notes. Every Friday, scenario framework for the week ahead. All of it free, but start here. Weekly structure first, always. That is the framework. This is not a signal. This is a framework. Piers Coleman, Crypto Market Desk. If this was useful, the next video covers liquidity in detail. What it is, where to find it, and how to use it to read Bitcoin before it moves. Link is on screen. See you there.